So today, at least hopefully, we can have some interaction, because I'll ask a lot of questions. If you were in the course last year, you'll know that's kind of the way I like to do things, is ask questions, because I found that when you're able to give feedback and get feedback, I think the learning process goes a little bit better, because we're going to talk about, gap-based stuff today. We're going to talk about things like revenue recognition. So approximately, if you were to guess about how many of your clients were gap-based, what percentage of your clients do you do financial statements, or would you say are gap? Approximately. I mean, see, this is working out just like a Zoom class. It's like a seat.
The ones that I do are mostly all gap.
Okay, mostly all gap. Okay.
Yeah, but I'm doing mostly auditing and reviews.
Okay, yeah, and so a lot of your assurance type of engagements are probably gap. I will say the bulk of ours at my firm are gap. Now, I've switched firms from where I was at, when I spoke to y'all last year. So like for the first 30 years that I was in public practice, I was in small local firms, which I think the biggest firm I was associated with, at one point in time we probably had 4 partners and maybe about 20 professionals. And so in November of last year, I made a change and I moved my part of the practice to another firm. And so I come from, at that point in time I was with a 3-partner firm where we had maybe 10 or fewer professional staff. So now I'm a partner in a firm where we've got 26 partners, we've got 200 plus staff, we got 4 offices, and so that was a big change for me. But the bulk of our clients that we do assurance work are gap-based. Now, in my former firms, we had a pretty decent mix between gap and probably tax basis and some modified cash basis. But today, when we're talking about gap stuff, we're going to talk about things such as revenue recognition. Yeah, did you all issue some statements this year where you were issuing some assurance on revenue recognition? Did y'all do some audit work? Okay. Yeah, so we'll talk about how that went, because I know you got it perfect, right? I'm sure our firm got it perfect too. We're going to find out, because our firm has peer review coming up before too much longer. How soon do y'all have peer review? Y'all went through peer review recently? This year, y'all had it this year? Wasn't it exciting? Was it different than what you've been through before? A little bit. Well, different shouldn't be a good term to use, but I do peer reviews, and so I know that from the peer reviewer side, that we have areas that we're really looking at points of emphasis for firms. Things like documenting risk assessment, and that's been a big point of emphasis for them. Revenue recognition is on their radar right now, where there will be an emphasis to making sure firms are doing that in accordance with professional standards correctly and so forth too. So, this was our first swing at it, and we did what we think was appropriate in auditing revenue recognition and helping our clients in preparing financial statements and notes regarding, revenue recognition under topic 606. So it's been a little bit of a challenge. But we hope that we got it right. So today I'll be asking a lot of questions. And the more feedback, the better, at least as far as I'm concerned. I'm not going to make you talk, you don't have to talk, but hopefully we can have some dialogue where we can learn, hey, this is what we're doing in practice, what do you think? And I can say, hey, this is what we're doing in practice, and let you know what we think. Especially when we think about things that we are doing for the first time. Now, when it comes to professional standards, are y'all early implementers? Yeah, I'm getting we're typically not either. There are some where we have. SARS 21, when they came out, we were early implementers of the preparation engagement. Because we had clients who needed financial statements, we didn't necessarily need reports. We early implemented that. With gap type issues in our clients, 99% of the time we're saying, hey, here's the deal. Let's wait until we have to do it, right? Because why?
Let somebody else figure it out.
We want somebody else to screw it up first, so we can figure it out, right? I mean, that's just the truth. Why do you think there is at least a year's difference in the effective date between public companies and non-public companies? If you look at the effective date of these FASB issues, there's typically a year's difference in the effective date between public companies and non-public companies. And I think they're going to move that to 2 years, at least that's what I've heard. Why do you think that is? Well, it's because the small practitioners, the non-public business entities, need more time. We don't have all the staff. We don't have all everything that we need for our clients to put that in place the way the bigs do, right? And so, you know, as practitioners, we like that too, right? We like to see how somebody else does it. Reminds me, I remember whenever I was doing peer reviews and the risk-based peer review, the risk-based audit standards came out, right? And so firms were having to implement risk-based audit standards for the first time. And I was doing a peer review of a firm in Oklahoma City. And I told them what engagements I wanted to look at. And they were like, those aren't quite complete. Can't you look at the prior year? Because we've heard that you can look at the prior year. I was like, yeah, I sure can, but I don't know. They're like, oh crap. You know, because we want somebody else to kind of go through the proving grounds first. So, and we don't always get that opportunity. You know, topic 606 was one of those this year. Everybody had to have done it. Now, if they hadn't issued financial statements by June, you know, they got another push with the effective date and so forth. And so some are still out there, but you know, we went through it, so we looked at the best guidance that we thought was available to us, and you know, we plowed through it that way. So for those of you who don't, I guess I should tell where I am, right? Where I'm from. I'm Mike Brand. I practice in North Alabama with a firm now called BMSS. It used to be old Barfield, Murphy, Shank and Smith firm, but BMSS is much easier to say than Barfield, Murphy, Shank and Smith every time. And so we're, I told you the size of our practice. We do a little bit of everything. We have a, I say separate tax department, but within our CPA firm, we have a tax track, we have an AA track, we have CAS, our client accounting and advisory services. In the Huntsville office where I'm at, in Huntsville, Alabama, we have a GovCon, a government contract consulting service. Also, that all they do is consult on government contractors. If you don't know anything about Huntsville, Alabama is a town of about 250,000 people. There's a big space and rocket center there. There's a big NASA presence there, a big arsenal presence there, Army arsenal. So there's a lot of government contractors that go on where you have these contractors who deal with government to provide services, to provide sometimes supplies, materials, and that type of stuff. And that's an interesting industry. So we do a lot of that type of work. We also do a lot of employee benefit plan audits. We do 60 plus of those. I'm kind of in charge of our municipalities, governmental, when it comes to those. So we do some of the larger cities and out there. We do a broad range of services. We also have, under kind of the same umbrella, we have Payroll Services and we have the wealth management service too. So for me, going from small single office firm where, you know, I did everything start to finish. And it's been like drinking water through a fire over the past year. A lot of good things, but it's just different. But at the end of the day, we all got to adhere to the same professional standards, right? Be it QC standards, be it, you know, ethics. You know, ethics, now, Idaho has a required number of ethics hours you all get, right? I've been for the past few years, been proud to say, I say proud to say, it kind of brags it. I don't have an ethics requirement. Because we did until September 30th, 2020, our employee year right there, we were required to have a minimum of 2 hours of ethics. And so our firm had me do a 2-hour ethics deal for ours. And you know, y'all talk about Zoom and not turning your cameras on and stuff like that. And so I was presenting to our firm, so we had about 200 on Zoom. And I made them all turn on their camera. I said, listen, if they were anything but ethics, put your camera on. It's ethics, right? Turn that camera. Why don't you have your cameras on in the first place? I'm just had nothing to go out of this classroom, all right? Yeah. Hey, well, because sometimes maybe we're doing other work. We want people to see where we're at, what we're wearing, stuff like that. So now, are you all back in your office now, for the most part? Everybody back in the office? We are for the most part too. We still give the option to staff if they don't feel comfortable, for them to be able to work from home or remotely whenever they need to, and we've done that quite a bit. It's hard to carry our meetings sometimes remotely, but we do. With this year, we did our very first remote inventory observation. Yeah, I did some heads turn like that. That was us too. So we've got a client who the owners are located in Austin. One's a lawyer and is broke, and so he's got 2 or 3 other entities that all get consolidated up. And one of them is he builds warehouses, and FedEx rents these warehouses all over the place. Then he's got another place, a sewage treatment place down in Florida, and then he's got a place out in California that manufactures and distributes pasta sauces and pasta. And so they didn't do a year-end inventory at 12/31. Something come on, they weren't able to do it. And so they had to move it into March of 2020. And they were located out in California. If you all remember, California was one of the first states that went on lockdown, right? That prevented folks from going out unless you were essential and so forth like that. And so our firm's a BDO Alliance firm, so what we typically do is have somebody from a BDO Alliance group go do that inventory. That's what we've done in the past. Well, they weren't able to get out and do it. So I called one of my buddies that practices in Los Angeles, and I said, y'all running anything like this? What are you doing? And stuff like that. He says, well, here's some of the things that we've heard we haven't done it yet ourselves. And so what we were able to do, because we had a good layout of what the facility was, and how it was laid out, because we had a good prior history with them, we were able to, the client was able to have a couple of iPads, and of course we would get the county, we would get everything sent to us, PDF, we would get the inventory printed out, we did, 4 sheet forecasts, all based on them going live with Zoom with their iPads, and they would go around, we'd have one, video on this way and one the other way, that would get a shot of everything around. Now this wouldn't work in every type of facility, if it were large, multi, everything gone everywhere. Like this one, we do a pharmaceutical distributor. Man, it would have been tough there, just because of the layout of their place and some of the locked up parts of their facilities and limited access as to who could get in there and stuff. But we did our very first remote inventory observation. It looked really kind of cool. But that gets us into the thought process, and we'll talk about this a little later today. What's audit evidence now? Because in the past, inventory observation, we'd always go on site and do it, right? We could physically see with our own 2 eyes right there what they had, and we watched them count it. And so now, can we rely on what we have seen through a camera's eye? And so we had to make sure there were some controls in place and that type of stuff. I was talking to Josh earlier this morning. He's like, yeah, we've had to really kind of condense on 5 years out in the future and do that like now. Instead of doing these type things in the future like we talked about, we've had to really accelerate those type of remote type things. I don't know if you all run into that yet, or if you ever will, but it's laid a little bit of groundwork for that. It's going to be interesting for me in the future audits how much time we're going to actually spend out in the field. Have y'all done a lot of stuff remotely now? Has it worked out well? Hadn't been bad. And we've got other clients who say, we want you there. Even though now we use advanced flow, we use all these other digital type things, and we hardly ever see a shred of paper. They just want our presence out there, so we've done that. But we were all kind of locked down, having audit team meetings when you couldn't always be there. Has really made us move into a digital age. Again, I was telling Josh earlier when I started at a new firm, the very first day I was there, they're like, hey, we're in the process of getting rid of all our desktop phones. So we're not going to have a phone on the desktop anymore. We run everything through Zoom. So I get Zoom phone, I got a little earpiece that I can put in when it comes in, that was already ring through to my cell phone. And it's got chat groups within there. Of course, we do meetings and messages and all that type of stuff through there. So everything's moving to the digital age. So when we get into the audit and the test standards, it talks about things like audit evidence and things like estimates, all these other things that have come about because we're kind of in the age that we're in. So, I don't think we really need to talk much about COVID-19. We all kind of know what's going on. Otherwise, it is kind of funny, but I say it's kind of funny. It's interesting, at least in my household. So I've got two boys. I've got a senior in college and a senior in high school. And between them and myself and my wife, now she's doing laundry and stuff like that. She'll have to dry back up, and you see masks along, right? Just the weirdest thing. It's just kind of odd, but it's the environment that we're in. And I understand. Actually, both my parents ended up getting the virus. They ended up not having to go to the hospital, but it affected them for a while. In fact, both of them got it in May. My mom ended up having blood clots in August in her leg because that's some of the continuing effects. I don't know if they know everything that it's going to be. But it's just odd. Like I said, it's the first time I've flown since January and going through DFW Airport in Dallas, which is typically just wall-to-wall people. They got stores closed, there's not near as many people. And about a 3-hour layover in my bag, still got to look at Dallas and do my airport. Yeah, so some things never change, some things never change. They do have some good COVID resources and so forth like that, if you're looking at some of these type things. But this is kind of how the day is lined up. It's very similar to what it was last year, where we're talking about, broad, FASB issues, narrow issues. We'll blow past most of these. Most of them have effective dates that are either already in place or are interim 2020 type things in the narrow scope. There's probably not much that's going to apply anywhere. So Josh has given us the green light to just flow through there. We'll spend some time in chapter 3. Okay, when it comes to Rev Rec, we'll spend very little time in financial instruments because there's just not a lot of updates there. And leases, we'll talk about leases, but the fact that they've been pushed out again with those. But unlike revenue recognition, where at least with our clients, we didn't see a big, if any, change in the numbers. For the bulk of our, we didn't see any change if there were any. It was nominal in the numbers. In the disclosures, all day long, we added probably 2 pages of notes. Probably. Okay? But when we talk about lease accounting, and if we ever have to implement lease accounting, which I think we probably will, even though I wish it was just like, go away. Keep pushing. Keep pushing. It will definitely affect numbers. Okay? And all your clients who lease. I don't know if you all have heard any of this, but I've heard, not necessarily from our local lenders, but just talking to people, they have said that some of their lenders who actually know about the lease accounting standard have been telling their clients who they have to have financial statements from, we don't want you doing that. We don't want operating leases on the books. And so when you do your financial statements for us, whatever you have to do, we want you to follow that. Have y'all heard any of that from any lenders? Like I said, I haven't heard any from my direct lenders, but I've had some discussions with people. I sit on a couple of committees and stuff, and they have said, they've told me, they said, listen, they've got lenders who are just flat out against it. Maybe they'll raise their voice enough to where we get pushed back, and maybe the PCC will get involved. We'll talk about who the PCC is, we'll get involved and have a gap alternative, maybe for a non-public business entity. But if they don't, it's going to change the client's financial status. In our Huntsville office, we have 2 AA partners up there, and I'm one of the 2. So myself and Jamie we've selected about 5 of our clients who do a lot of leasing, who have some significant leases. And we've asked them just to go ahead and get some numbers together for us about what their leases are, what they lease, what the terms are, and that type of stuff. And we're going to just run some numbers. We're going to estimate some numbers, and then we're going to project what a balance sheet's going to look like. And we're going to throw it out to them, and then we'll have a meeting with them and their lenders. Say, hey, by the way, you've got significant debt covenants. And you got a lot of ratios that they're gonna have to comply with. And this is what's gonna look like. So right now, we need to start restructuring that loan, maybe changing some of these covenants, or we need to get some waivers in place before this thing gets stuck out, because this will change. It'll flat out change the numbers. So we'll talk about red, and lease accounting, a little bit about financial instruments with CECL, with your current expected credit loss model and so forth. Private company financial reporting, that's where we're talking about the PCC. We'll talk a little bit about what they've done. Now, they started off on fire. They put out some good things really quickly. They did about 4 issues really quickly. One of the ones that I like that they put out a little more recently, like in 2018, and you all have clients who have VIEs that require consolidation. You all have any of those? Okay, you've got some of these non-public business entities that have VIEs that require consolidation, and your clients are always like, okay, I don't get why we have to do this, but I see why we have, I see what they're on there, and so forth like that. They issued a FASB, the FASB issued an ASU in 2018 that says, hey, for these non-public business entities, you don't have to consolidate any VIEs. And you've got a lot of disclosures you have to make around those VIEs, but if you don't like how they're consolidated on the face of the financial statements, you just have disclosures. That's not for public business entities, and it's my understanding y'all do public company work, and I don't do public company work either. But if you got a non-public business entity that always just struggle with the whole VIE type thing, well, now there's a gap alternative that if you elect, or if your client elects, I always say you, it's not they're not our financial statements, right? They're our clients. We like to take responsibility for them because we make them balance, right? We make sure they have debits where there should be debits and credits where there should be credits. But we can tell, hey, by the way, if this really bothers you the way they're on your financial statements, there's a gap exception. You're going to have significant disclosures that have to be separate from all your other disclosures. But if you don't like the way it kind of boogers up your financial statements when you read them, right, then we can do this. We can have this gap alternative. We won't really get into the gap, FASB exposure drafts and projects. We'll talk a little bit in Chapter 6 about the current economy, even though it's changing from day to day. When the outcome of the election is determined, it will change again. You know, if you just listen to what the stock market's been doing, right? So I drove back from Idaho Falls yesterday. Oh, I stopped in the craters of the moon. Y'all been to that place? That's pretty cool, right? And so anyway, I thought, I'm gonna stop there. So I did, and I hiked about, I did the, I don't know if it's the North Cone or whatever like that. It's almost 2 miles out, 2 miles back. And you get about 1,000-foot elevation gain and stuff like that. It was really cool. Really windy, but it was just really cool. But on the way back, I was listening to the radio. They're like, hey, the stock market, you know, it's up 5. And then they say, you know, well, it's down. It's just all over the place now. And so when this course was updated, they can't update it for how quickly the economy changes. But what I want us to think about is how the economy really affects what we do when we're planning for and that says for audit planning, but I'll be honest, it's for planning for any attestation type engagement, whether it's compilations, reviews, or audits. Because one thing we have to do in every one of those instances is what? We got to read those financial statements. And you're reading them maybe for material inconsistencies, to ensure there are no material modifications need to be made, or to obtain reasonable assurance that they're in accordance with GAAP, whatever it is. And the economy is going to affect the way those things look. Josh knows you'll have some restaurant clients. And I would dare say, if you didn't know what's been going on in the economy, you wouldn't really know what to expect from how those financial statements would look like, right? Where I live, I'm in North Alabama, but my family goes on vacation down the coast every year. And so, you know, when we're down at the beach, there are a lot of stores, restaurants, entertainment venues that make their money in summer. They depend on tourist money. And they're closed every winter months. Well, this year, you know, our beaches were closed for a while, not only for the pandemic, but we've had 87 different hurricanes come through that area. Like we're all the way up to the Greek alphabet now. Ada, I think, is what's out there right now. Zeta was the last one that came through. And they're all hit. And so it has significantly affected that area. And so if you didn't know all that was going on, how would you know what those financial statements should look like? Maybe you get something to look great because they know they got strict debt covenants at the bank, so they don't have to do what they got to do to make sure that that debt doesn't get called. So we'll talk about, in that chapter, some of the important things around the economy and how it would affect those type of things. New SASs, we'll touch on the new SASs. They all got pushed out, right? And unless y'all want to be early implementers, y'all can be the torchbearers for the rest of us. Ain't nothing wrong with that, right? We'll talk about how it affects it. But SAS 141 puts the effective date out another year. And so we won't spend a whole lot of time on those. We'll just touch on what they are and how they might impact things in the future. The SSAEs, we won't spend a lot of time in there because there weren't really any significant changes to the SSAs except to agreed upon procedures. Do y'all do any agreed upon procedures engagements? No, any AUPs? No, I kind of like the AUP myself because it's a no assurance type of engagement where it's a findings, it's a report of findings. That's all it does. We don't offer any kind of assurance or conclusion. That was really the only change we made within the AUP, so we won't spend much time there. We'll talk about SARS engagements, press comps, and reviews. I think this course covers the updates of SARS 24 and 25. SARS 24, a whole lot of changes with SARS 24, except when it comes to going concern type things and review engagement. SARS 25 came out this year, and at least in my own opinion, it has some pretty significant changes in it. Okay, it will allow you to issue an adverse conclusion in a review. If you ever wanted to do that, you probably think, why in the world would I ever want to issue an adverse conclusion? Well, I've had some of those where we're performing a review engagement that the financial statements were just so awful, we ended up withdrawing. And then that client would go to somebody else and they'd issue a set of financial statements. And I'd be like, how in the world? Well, because somebody will undercut us in fees, somebody will do something a little different. So what the ARS did, the ARS says, hey, here's the deal. If something's like that, it's pervasive, it's throughout, it's material, then now we'll allow you to issue an adverse conclusion. I mean, the client doesn't like that. They don't take someplace else anyway. But we have the ability to be able to do that where we have in the past. It also finally defines the term limited assurance. Reasonable assurance in an audit, that's our highest level of assurance that we'll report on in financial statements. Reasonable assurance has been defined for years as high but not absolute. No assurance, we understand that. No assurance is no assurance whatsoever. But ever since SARS 1 was written in 1978, there's been no definition for what limited assurance is. And I chaired the ARS for a number of years, and we could define limited assurance. We looked to the international standard setters. They use a term called moderate assurance. It's about a 2-page definition that confused me more than helped. Well, the ARS has now defined limited assurance, and when we get to the definition, you'll say, well, that doesn't really tell me much. I'm with you. Because it says, hey, it's not absolute, but it's not enough. Basically, is what it is, But it is defined now. And it also talks about materiality. And has some explicit requirements for determining materiality and review engagement. And it did cover that before. Y'all do review engagements? Yeah, so now with SARS 25, there will be some definite determination of materiality. And I think whenever it tells you that there's some definites when you're having to determine materiality, then there's going to be some documentation issues too, where you're going to have to document materiality. Where we hadn't had the requirement to document materiality in the past. If anybody still got a pulse after chapter 9, we'll probably know. But there's some other recently issued guidance that really, there's not a lot in there that I think is impactful. Now, the enhancing audit quality is interesting. Anybody heard of Cpa Evolution? I was talking to Josh about this earlier. Anybody heard of Cpa Evolution? The evolution of the CPA exam? Anybody in here still taking an exam? Yeah? Okay. Get it done. Get it done. Not that it's going to be more difficult. Listen, it was never more difficult than when old farmers like me took it, right? Because I was the whole, 2.5 days, all you can take in there was a pencil and a book of stamps, and you can get your booklet mailed back to you. And the young people out there, oh, he's one of those. He's going to tell me how awful it was when he took the exam, how much harder it was when he took it. Let me ask you this. Do y'all have to memorize the standard auditor's report these days for the exam? No, hey, we did. See, that's tough, right? And so if we were getting to the new SASs, well, that's about a 2-page. Man, I wish I should have had to. But it's just different. But with CPA Evolution, I was talking with Josh, and Josh says, we don't, at our firm, we don't necessarily have a tax side and an audit side and a cash side. We have some who may do more work in certain of those areas. But our firm, we've got our tax group, and we've got our audit and assurance group. And then we've got our CASPA, so we have different ones like that. And for years, I did both tax work and audit work. This year I did 6 tax returns this year. 9, my 2 kids, my in-laws, my parents, and sister-in-law. That's it. It was great. Glorious. Best tax season ever for me. They could have extended, I don't care. I'm still trying to find somebody to do my dad's tax work. I'm tired of doing this stuff. He sends stuff to me on the legal pad, right? And he writes about this big. It's horrible. So if anybody would like to do that for my father, just see me after class. And I'll be glad to pass that on. But what the CPA Evolution is, now this is part of for the AICPA and NASBA, the National Association of State Boards of Accounting. I'm the current chair of the board of directors for the Auditing Society CPA, so that means I have a seat on the board for the American Institute of CPAs as a state representative, okay? And so in our meeting around, was in October of last year, we voted to move forward with the CPA Evolution. And what this is going to do is really kind of change the format of the CPA exam. And you can go to cpaevolution.com, I think is what it is, and really look at kind of the details of it. But the exam is going to have tracks to it now. I say now, it's probably 2 years or so away. You're going to have to get psychometrists involved to work with the testing and development of all that type of stuff. But what it's going to do is you'll be testing probably 80% of the core. The core skills we always have as CPAs, right? And then, based on what area you're going to go into there, that you want, I say you're going to go into, that you're going to have to choose your track basically. And it's going to be either tax, a test, audit, assurance, financial reporting, I think is what they're calling it, and then like IT side of it, okay? And you'll have 20% of your exam that is in that specialized area. There's higher knowledge in those areas. Now, when you're through, when you pass it, you won't be CPA-tax. You'll still just be a CPA. And so, we have a lot of questions about that. For me, my first instinct was, dude, it took me probably 2 or 3 years into practice before I really kind of figured out what I wanted to do, what area I wanted to be in, and what does this do to the small firm? What about the generalist? What about the sole practitioner? How do they do that? And will somebody with a tax emphasis still be able to sign an audit report? So there's still details like that to work out, but I'm telling you, that's where the future of the CPA exam is going, where it will kind of specialize you like that. You can get a master's now with the tax emphasis. You can get a master's, that type of stuff. And I think what they did is they really kind of looked to see how the professional engineers kind of do it, because you've got mechanical, chemical, all those type of engineers and stuff too. But that's the way CPA Evolution. I don't know if that's in that recently issued guidance or not. I think they've updated it for that, but I think that's an interesting aspect of where our profession is going, right? And so when we think about these different tracks, understand if you're in the process of taking the exam, get it done. Or, if you think, hang out with it, have one of those special, just hang out for a little while. Just keep working. Don't be taking that exam, and you'll get your wish one day. I remember I was on one of the, whenever they moved from the written exam to the computerized exam. So they asked CPA to form a couple different groups to work on that. I was in one of those groups going through that whole transformation process. And I remember thinking, what kind of guy I got to take his computerized exam. Of course, he might pass the exam, like, nobody will take that again, right? And so we don't necessarily. But going through that whole process, as much grief as I give people about how hard it was when I took it, listen, it was about 65% memorization work at that time. It just was. It was memorization work. I remember taking Becker CPA review course. Anybody else taking Becker CPA review course? These big old mnemonics and flashcards at that time and all that type of stuff. And it was memorization work to memorize the things that were typically on the exam. Well, then you roll back about 2 or 3, maybe 4 years ago, they kind of changed the format. You go from 65% memorization to about 30% memorization. That's just practical application. To me, that just makes sense. That gives us better prepared CPAs for those of us, who are hiring folks and stuff like that. So it gives us a little better folks coming in better trained. And so then I think maybe the testing around the Cpa Evolution exam, like our office in Huntsville right now is looking for an audit manager, it's looking for a tax senior, those type. That when we're looking for those type of people, then after the Cpa Evolution, those may be the ones we look for. Hey, what's your emphasis on the exam? What was your emphasis doing that? You would fit us a little better here. And so maybe that helps us going forward. So, anybody ready to take a break here? I'm just kidding, we can't yet. Well, we could, but we'll be here for a long time. Do I have plans tonight? Hope not. Okay, so let's get into the exciting, always exciting, never disappointing FASB issues. And these are ASUs, again, we're not going to cover, I don't think this slide that covers any that were issued in 2020. And the reason that it doesn't is because the effective dates of those are typically on out 2 or 3 years, right? And so, to kind of go over those in a course like this, you think, okay, I got a little while. Even though we're covering leasing accounting, we've got another couple of years for it almost, right? Even though we've been talking about RevRec for a bunch of years now, okay? But we're going to talk about some that are in place, some that will be in place soon, some that may impact you. If they don't impact you, we're going to move along, all right? So 2016-15, the way these are laid out, we got acronyms for days, the Financial Accounting Standards Board, Accounting Standards Update, FASB ASU. 2016-15 means this is the 15th one issued in 2016, it's probably toward the end of the year. Talks about cash flows, right? Everybody here like statement cash flows? Y'all are indirect or a director? What kinds you like? Direct or indirect? What was that? Indirect. Indirect, right? Because it's easier to prepare. Is that correct? Yeah, easier to prepare. You ever gone over an indirect statement of cash flows with a client? So hey man, you change the balance sheet account. If it went down here, we put it up here. They're like, yeah, okay, that's helpful. But then you go to the direct method, right? You tell them, hey, that's all the cash you received during this year. That's all the cash you paid. So I'm with you. Indirect, man, easy preparation, I'm with you all day long. The FASB actually prefers the direct method. And so, for most of my clients, we do an indirect, but there are some that we do a direct, where it shows, cash inflows and cash outflows. This is all the cash I've received from my clients. Here's all the cash I paid out for materials, for payroll, and so forth like that. Now you understand that a little bit better. Sometimes it's a little more difficult when you get out of it. But there's just sometimes areas in a statement of cash flows when we're not really sure where that cash flow came from. Whether it's operating, financing, or investing, right? And maybe we think, should this be classified here? I don't know if you go to review statement of cash flow or prepare statement of cash flow, and I'm just not really sure where that goes. And that's all this FASB covers. There's probably 8 different areas, 7 or 8 different areas. Things such as insurance, where are insurance proceeds? Where's that located on statement of cash flows? Well, it really all depends, right? Life insurance might be from investing. If it's an umbrella policy that covers a building, maybe that's fine. It just really all depends. And so that's what this talks about. Debt prepayments, settlement of zero coupon debt instruments, where it's located. There are some of your Consideration proceeds of insurance claims is really classified based on the nature of the loss. Life insurance is investing. Distributions from equity method investees. And then number 8 just says, hey, at the end of the day, you can't figure it out, you use the predominance principle. Anybody ever have to use the predominance principle? It's kind of a guess method. I mean, just go, if we're just being honest here, right? It's kind of the guess method. It's the predominant source of that cash flow that says, hey, if you can determine what it is, if you can apply specific guidance, do it. Or if you can determine an identifiable cash flow based on the underlying nature of it, then okay. But when they're not separately identifiable, use the predominant source for classification. Well, for me, if I knew the predominant source, I wouldn't be at that point. I would know where it came from. So it's kind of one of those, take your best guess method and do it consistently. That's your predominance principle. At least the way I understand it is. So when we look at effective dates, again, you can see a lot of these may already have an effective date for calendar, for fiscal years, and then for interim periods, it's going to be a year later. Since you all go to public company work, we'll skip straight to before all other entities. And so this has a calendar 2019 and an interim in 2020. And you'll see some of these will allow for early implementation. Early application is permitted. And then it says like a retrospective application should be used. What does that mean when it says a retrospective application should be used? You know what that is? Why, hit the break, y'all will be talking like crazy. I can just about guarantee you. Your class, you're like, Silence of the Lambs, no max. Can't do this right. I'll tell you, some people get pretty creative with their max. I've seen some, I like, you got a pretty cool man. I've seen some that had their face, some people have had their face printed. Had printed, y'all seen any of those? And it looks like a real face. It creeps me out sometimes. Like, hey, I got, hey, tell me that's about, oh, okay, yeah, I see that. And so they're extreme ways. What does it mean, retrospective application? Because you got a choice, right? You got modified retrospective, prospective, retrospective. So when it says retrospective, what does that mean?
You're gonna go to the past.
Yeah, go back to the earliest period presented on the financial statements. And you'll go from there. And so as we go through some of these, when we get to prospective, I'm going to ask you what that means, and we'll see modified retrospective. So with all these, we'll kind of make a determination. We're going to show comparative year, single year, whatever it happens to be. If it's multiple year, you'll go back to the earliest period presented and carry it forward. The next one is also a statement of cash flow issue that talks about restricted cash. Do y'all do any not-for-profits? Y'all do any non-profits?
Yeah.
Yeah, okay. I've seen non-profits. I've seen maybe some utilities that have some restricted cash. How do you handle restricted cash on statement of cash flow?
Don't you have to separate it now?
What's that?
Don't you have to separate it now?
I'm asking the question, not wrong. Well, all this says is restricted cash on statement of cash flow is just cash and cash equivalents, right? Unless maybe, if not, maybe it's an investment thing. Because first of all, you got to see what their cash policy is. What do they determine to be cash and cash equivalents? You know, those that took that maturity of 3 months or that, whatever it happens to be. But restricted cash is really treated no differently than unrestricted cash on statement of cash flow. So you'll see it down at the bottom, changes in cash and cash equivalents. Now, I've seen some people break that out, changing in unrestricted cash, changing unrestricted cash, but it still all goes down at the bottom. It's not a separate cash flow from an investing activity or an operating activity. Okay? That has an effective date of calendar 2019, interim periods in 2020. And again, you can early apply it. Of course, we're talking about something that has an application date of 2019. But if you're doing interim financial statements, or your client has interim financial statements in 2020, maybe this is the first time they've applied it, you'll have a retrospective application for it also. Intangibles. Now, Goodwill. What's Goodwill? There we go again, signs of goodwill is, right? Plug balance, basically. Yeah, I mean it is. People laugh. They're like, oh, that's funny joke. It's not a joke. That's what it is. Because you got separately, let's say you make a business's purchasing another entity, right? You got items you can separately identify. Maybe this cash, debt, this has to go to capital assets and all this type of stuff. You got this, and then at the end of the day, you got balances just that you don't know what it is, right? And what is it? What's goodwill? And so goodwill gets set up on the books. And for years we were able to amortize goodwill. And then the FASB says, no, we don't amortize goodwill anymore, but we'll test it annually for impairment. And then the PCC came along and said, oh, by the way, if you're not a business entity, you might elect to go ahead and amortize it again. And so maybe some people did, maybe some people didn't. For those who didn't, you're still going through the old impairment testing on an annual basis. How many steps is in your impairment test? You know how many steps that one is? I say this is not a trick question, but it kind of is, just because of the way the FASB numbered their steps. If I told you, if step 2 was the last step of the test, how many steps do you think it had? You probably think it has 2 steps, right? But they start counting 0. So it's a 3-step test, and you got step 0, step 1, step 2. And so they're just eliminating step 2. The FASB, for probably a couple of years now, they're talking about we're trying to simplify GAAP. We're trying to simplify GAAP. Of course, this is after they issued RevRec and lease accounting. They were both continuing projects, and one's over 700 pages. Yeah, we can simplify that bit. I don't want them to simplify anything else, but that's the way they're going to do it, right? But they're in the process of simplifying. So the thing to a 2-step test. They get rid of step 2 of the old test. Now, this doesn't apply to private companies who are elected to go ahead and amortize again, and a lot of private companies have. And so now this old step 2, now it is truly a 2-step test. I don't know if they renumbered them. I don't know if there's still step 0 and step 1, or if it's, whatever. But they've eliminated that. And so they've simplified it by taking a step away. Took away the easiest part of it, but that's okay. Years beginning after December 15th, 2021, so this will be a calendar 2022. So this one's pushed on out there, but this is one of those that will allow early application, and it has allowed early application now for a couple of years or so. This is one of those that if we're having to do this for a lot of our clients and we want to cut down some of the costs associated with this impairment test, that we talk to our clients and they early, because it does simplify it somewhat. Now this one you apply on a prospective basis. So that's different than retrospective, right? What is a prospective basis?
And this year moving forward.
This year moving forward. And so we don't have to go to each period presented. Now for some of these that are prospective basis, and you still do comparative financial statements, it may not be looking apples to apples for your client. You may want to do some note disclosure, possibly, or may want to recommend some note disclosure that talks about the differences if it ends up being a significant difference. This is testing, and they don't see it. It usually doesn't come out on the financial statement. So that's why they have it like prospective on these, because it really doesn't affect the way these financial statements look. Peer-to-peer activity. You wonder why they got these slides in here? You wonder why they have slides in here that say, and we'll go through the day, you'll see this peer-to-peer activity. And you'll see, well, if I go back, look, it's got 2 people and like words, which means, we're having discussions among, why do you think they have these within these slide decks? It's so they don't go to a competency-based training model. You understand the concept of a competency-based training model? You know what that would mean? Yeah, I mean by I told you we'd be done at 3:30 today. They're probably starting about 3:10. I'll be handing y'all tips. I know what you're going to do. Good thing everybody has your own. This reminds me of the old Cpa exam. You had to take it on the side, right? I mean, that's when we sit like one person to a table. Okay? We work by the fire light, because I'm old. But we now I just lost my whole track of thought where I was talking. What was it? Competency based. Thank you. Actually, I probably, would you like to come up here and say, I'm glad that my company is like gone out the door right now, right? So the company, I would write up an example, y'all think about that, that's an easy example either, because he would say like, what's the right answer? You just put something down, and he forget all about it. That's probably the case. What's that? Competency-based training, right? Where you have to take an exam afterwards. And listen, I do peer reviews, and so I do specialized industry reviews also, which means I'm looking at single loss, I'm looking at employee benefit plans. So each year, I have to take like a 2 or 3 hour update, and I'm always tested at the end of it, right? So, you know, they require us to have a minimum of 40 hours. And, you know, who decided 40 hours was appropriate? I don't really know. But, you know, how do you know you're getting out of this what's set up for you to get out? You know what I mean? If we're trying to learn things that are applicable to our practice, well, that's why they're thinking about a competency-based model. Now, I'm of the opinion if they go to a competency-based training model, they may want to consider the number of hours necessary, right? Like the state of Alabama, our Alabama State Board of Public Accounts said, you know, they're the ones who set the requirement, right? They said you get 40 hours of CPE a year. At a minimum, you're required to have a minimum of 8 hours of CPE in A&A. So our tax people don't like that. Because they never, and we don't want them to ever touch an A&A project. I'm serious, we don't. And just like they don't want me to touch tax. Even though I got some tax experience, I can spell. They have to have 8 hours of A&A. And what's logical about that? They've been talking about changing the CPE model for a number of years now. That's kind of been pushed back. So the competency-based model, don't worry, I don't think it's coming soon. But we certainly want to make sure you get something out of this. And so that's why they have this peer-to-peer activity. That's why I try to interact like this and ask questions to see what you know, to see what you may want, if you need some more information on. So we're not necessarily going to go through some of their question and answer process because we're doing that also in the process. We'll just be glad at the end of the day, we don't have to take tests on it, all right? Okay, now this is actually a topic 606 issue. Yes, sir.
Can we talk briefly just about Goodwill?
We can.
A scenario where a client applies in business. So it's the first year, and not maybe this new standard, just kind of general, because there's a big experience gap here. So I just want to just talk with you about that.
Okay.
When you're reviewing that, let's say it's an audit, and the client presents, here's what we bought, here's the tangible assets, and here's how we can, maybe the purchase agreement, maybe doesn't agree, it doesn't actually specify, sometimes they do, maybe they don't, but the client presents, here's how we allocate it, what's your responsibility in an audit, to say, does that seem reasonable? What's your approach?
Okay, and so for those of you, maybe if you didn't hear, the approach is first year of auditing a company after they require somebody. And so out of that acquisition comes goodwill. And maybe the operating agreement talks or the purchase agreement talks about it, maybe it doesn't. What's our responsibility as an auditor to get sufficient appropriate audit evidence that number is appropriate, right? And so for me, first of all, it's going to have to be risk-based. What's the risk? Is that a material amount? And so I'm going to assume, yes, it is. And so if we assume that's a material amount, and so I'm assuming there's probably a higher level of risk within that, what's our responsibility to test after that? I'm doing probably, obviously I'm doing an inquiry, I'm reading what that contract says. If it's slightly different than what that contract has, maybe I go through and I look at what some of those separately identifiable assets are. And I go to some of the underlying data between those separately identifiable assets. And more than likely for me, I'm going to do a reasonableness test. And just go back and kind of recalculate on my own to see what I would have come up with if I were to done the calculation. Not because I'm the all-knowing guru of goodwill, but because those are some of the tests that we would typically do, right? So I'm liable to do a reasonableness test. And for me, if it's within spitting distance, then that's not a technical term, spitting distance, it's something I use. But if it's within a reasonable difference, then more than likely, I would deem that to be appropriate, audit evidence to carry on. Well, let's just say I come up with a significant difference. What do you do then?
They paid that amount. They paid that amount.
They paid that amount, and you come up with a significant difference. Well, what I want to do with them is I want to get together with them and say, hey, where our difference is at here? Because we've got allocated to these capital assets this, but yours came to this, right? And this, and so that's what I'm going back to management. It's like doing an analytic, right? And when we're doing an analytical review, we kind of develop expectations. And when something falls outside of that expectation, we go on. And so I look at the same approach to audit testing, right? So we're doing a test based on our risk. And if there's still a difference at the end of that testing, then maybe the risk is higher and maybe I have more tests. Now what those tests are really going to be specific to the client, the industry, and so forth like that. It could be we go back to who did the calculation in the first place and have some discussions with that person. Maybe we go back to the business acquisition and maybe the financials that those were built off of was a different iteration than the one that we got hold of. So there's just, all I gotta say, you can't stop after you do a reasonable test and it didn't quite hit what you thought it would.
Because they'll agree to it from a tax standpoint, right?
That's right.
That you could have a difference. That's what they agree to on the tax, and they're gonna have to follow that tax. So it doesn't matter if you do a job, that's what the tax.
That's exactly right. But that's when we explain to them the same tax. And GAAP has a requirement for this. Just like when you're amortizing that for tax purposes, 15 years, not 10 years. So you've got differences. And we could have these differences right here where maybe it was booked on a tax basis, not a GAAP basis. And if that's the point, we go through the GAAP calculation, and maybe we propose an adjustment. And if they say we don't really like that, then I've got some problems. Then maybe I've got a scope of the or maybe I haven't except for. That would be one of those perfect except for that says, hey, these are in accordance with GAAP except for. There's certain accounting principles require, this to be accounted for in this manner, they account for it on a tax basis of account, and maybe we have a difference that way. Did that help out anything? Okay, good. Any other comments, questions? Listen, Goodwill, we see it a lot in companies that make purchases, and you see that more and more these days. I think at least we are. I don't know if you all are, but goodness, and all the consolidations that we've seen, all the equity that, and boy, all our government contractors like to have what they call these joint ventures. And these joint ventures end up rolling up in there because they have to be consolidated and so forth like that. And that's actually we had one of our clients this past year, calendar year 2019, had a joint venture in China. And so we got an audited set of financial statements that were in Chinese. Yeah, and so Google Translate, have y'all ever used that? We had to try to translate it using that. And we were able to for the most part. But then we had to determine the basis of accounting because it was a little different basis of accounting. We found more literature that says it closely approximates GAAP, but it's just, you're going to have to do these things from time to time. Good. 2017-05, this is a topic 606 issue. When you see this FASB issue number 2014-09, okay, that has to do with revenue under topic 606. This one, let's see. This one has to do when you've got revenue or you've recognized a gain or a loss from a non-financial asset in a contract with non-customers. Let me read that to you again. This has to do when you have a gain or loss from a non-financial asset in contracts with non-customers. Can we read for you one more time? Because I don't know if it's going to help me out any more than that. I don't know that I've ever run into this in practice. So this has to do when you're talking about taking a non-financial asset and you're using it in exchange with a non-customer. Y'all ready to move to the next slide? I'm sure I hadn't seen this in practice. All of this is under the broad, and I'm sure maybe it happened somewhere. I just hadn't seen it in practice. Okay. Comprehensive income. Y'all still deal with comprehensive income? Yeah. Other comprehensive income? Y'all ever have to deal with that? Yeah, okay. So this came out in 2018-02, so this is second one in 2018-02. This came from the Tax Cuts and Jobs Act. Tax Cuts and Jobs Act. That said, hey, if you still have these people who have deferred income taxes, what happened to the business income, the corporate income tax rate under that act? It got cut, didn't it? From a blended rate that had a higher amount of what, 39%? Was that the highest? 35% salary tax rate. But it had the highest, but it got cut to a flat rate of 21%, right? And so when you're doing these deferred tax adjustments, calculations, and GAAP says you record it whenever it is in place, and so the Tax Act took place immediately right then. That would mean in some of these statements you could have a big change in your deferred taxes based on that tax rate, right? And so if that were the case, that would hit the income statement. And could be a big hit to the income statement, one way or the other, good or bad. And so all this thing says is, hey, if you've got one of these, and that has this change in tax rate as a result, and you can make an election to take that directly from accumulated comprehensive income to retained earnings. Okay? And so it just allows you to do it that way instead of running through the income statement. It didn't dilute the way things looked at that point in time, because just imagine doing this for your client. Do they understand deferred taxes in the first place? Yeah, okay. And then you hit with this. And they're like, man, I just made a ton of money. Or, boy, we had a bad month. This will help them out. That has an effective date, fiscal year beginning after December 5th, so this is the calendar 2019, and interim periods within that. Fair value measurement. Y'all ever have to deal with fair value? Yeah, we do from time to time too. You know, you got your level, your three levels of assets and so forth. Under that, well, you'll know that fair value note is pretty in depth, takes up a lot. What all this does is it changes some of your disclosure requirements around it. You can see it eliminates some. When we're talking about transfer between levels 1 and 2. And you don't have to disclose the policy for transferring those assets, the timing of the transfer. We don't have to disclose the valuation process for level 3 managements and measurements. There are some modifications as far as, you know, instead of doing a roll forward, you'll just disclose some of your transfers in and out of level 3. And it also adds some disclosures. And so, you know, they give it and they take it away. And then they modify it. So at the end of the day, it's probably a push. You know, you probably still have the same amount of disclosure, they're just slightly different. And so you can see there were some that were added that has an effective date for both interim and fiscal periods in 2020. So this is a 2020 that handles both calendar and interim. Let me ask you, do y'all do any EPP on this? Prospective planning? Yeah, and have you all ever run into, you know, a number of times, I was reviewing one that, the standard, okay? And so the standard handle all the investments and so forth like that, and a lot of times some of these groups like that will put out what their thought process is on where these investments should be classified under fair value. Levels 1, 2, or 3. And so we were working with one that had a stable asset fund that they said should be level 3. And they had a number of mutual funds. They said should be level 2. Have y'all ever disagreed with what their recommendations are? Yeah, we ran into that more than once this year. Because we could go straight to those that they had classified as, they said should be classified as level 2. We could go straight to the closing market where you find that value right there, that's the same value they use. And so we classify them as level 1, and level 2 is the level 2.
And they were actual securities, not like one of the biggest.
That not one of the biggest, absolutely. Because we went through all, because we thought, okay, that seems odd, so we did a little bit more work, all right? And matter of fact, there's a gentleman, he works for a firm in Chattanooga, but he teaches the 401k class, he teaches a lot of EDP classes. Randy Dummer is his name. Nothing like going to a guy that asks him a question and his name is Dummer. Yeah, so dumb, ask Dummer. He agreed with us. He said he's sitting there in practice and so forth like that. He said, but read what they say. This is just a guideline. It's not, they're not the accountants and so forth like that. But that can happen from time to time. Don't always just rely on the information that comes from somebody. Okay? Consolidation. We're talking again about VIEs. Now, where did the whole concept of VIEs come from in the first place? I talked about VIEs a little bit earlier. But where do VIEs come from? Enron, all right? Anybody watch The Smartest Man in the Room? The documentary on Enron? You ever seen that? Yeah. Nasty stuff, boy. I mean, y'all know how much Anderson was getting paid on a weekly basis to do work for Enron? Basically. $1 million. They're looking at annual revenues of 52 million plus. I can do okay with that. I'll work for it for about a week and be just fine. I do believe. But when we think about all those off-balance sheet accounts that came out of that, and then we see all the trickle down, SOX came out for all that type of stuff came, and all that stuff kind of trickled down to the non-public business entities also, where now we've got to consider consolidation VIEs. We go through the whole thought process, and part of that thought process is decision-making fees, what kind of decision-making fees were paid, and we look at it as an across-the-board deal with all of your VIEs. Well, this one just says, hey, you should do that really on a proportional basis. So you've got a smaller potential VIE that has to be consolidated based on the overall decision-making fees paid. Well, really, that should be done on a proportional basis in determining if an entity is going to consolidate a VIE. And that makes sense to me, and so that's what this guidance says. Because current guidance requires the evaluation to be based on the entirety, on the entirety of the VIE. And so really this should probably reduce the number of entities that are required to consolidate based on those decision-making fees.
What's the decision-making?
Well, and we don't deal with a lot of decision-making fees, but like management type fees that would be paid to manage all these different type of entities, like maybe there's a holding company that you pay these fees to manage all of those, that really it shouldn't be the overall fees paid to the consultant or whomever who kind of consults based on what's going on with those different entities. That it should really be on a proportional basis. So this has an effective date for 2021 and calendar years in 2022 where you can early adopt, and again has a retrospective application. Not-for-profit entities, did you say you all do or do not?
Yeah, we do.
Y'all do not-for-profits? Okay. The firm I was at on Tuesday didn't do not-for-profit work. So, this updates the definition of collections. Now, why is that important? How do not-for-profits handle? Do y'all deal with not-for-profits that handle collections? It could be that you deal with not-for-profits that don't really deal with these. The decisions that not-for-profits who handle collections have to make is, should we capitalize them or show them otherwise? Maybe expense some of these collections. And so this just has to do with determining what they would capitalize when they did. Oh, there's my point. I've been looking for that all day. Y'all over there say, I can't see the point there, did you? I can't see the point. So it applies to all not-for-profit entities, and it just gives them criteria on whether they will set them up and depreciate them, or whether it's just part of a collection that carries on. The firm where I work at now, we've got a client. It's a Cook's Pest Control. It's a pest control firm that's located in Decatur, Alabama, which is kind of south of Alabama. But they've got a lot of pest control offices nationwide. And 2 years ago, well, it's been a little bit longer. They just started up in 2019. They had their Cook's Museum of Natural History. So now they have a museum also, and it doesn't just have bugs in it. So it's not just it, but they have a lot of collections. And so some of these collections and exhibits will move from time to time, from their place to the museum and so forth like that. So how they account for it is really where this kind of comes into play. It's a really neat museum, by the way. At first I was like, man, I just don't want to go see about bugs, like termites, and they have a lot of other things in there. This one has an effective date, calendar 2020, interim periods of 2021, and again, early application will be permitted, and you can do it on a prospective basis. Now, whenever the PCC issued their exception or alternative to allow non-public business entities to be able to amortize goodwill again, not-for-profits were not included in that. Okay, so not-for-profits were excluded, so not-for-profits still have, if they've got goodwill on the books, it had to go through your annual impairment testing. Well, all this one does is say, by the way, now not-for-profit entities may elect to amortize goodwill the same way that these non-public business entities do. Okay? Oh, got a sneeze coming. And I'm going to sneeze right into this. And so it's going to eliminate the need for mandatory annual goodwill impairment tests. You'll only test if a triggering event happens. Now, what would we're going to talk a lot about goodwill today. What might be a triggering event to lead you to believe that goodwill might be impaired? I could ask, what triggers you? But man, I get a lot of answers here, right? I gotta sit through a class like this. I feel great. What would be a triggering event to make you would think goodwill might be impaired? Lost money. Okay, so let's just say that this business that the purchase happened from, we got goodwill. Well, that business all of a sudden it skids, right? And so they've got, you drain cash flow to them. So you lose cash, you lose money. So that could be a triggering event. When that happens, then you test. You'll only test when a triggering event happens. And so it changed that. Instead of having to go through an annual impairment testing, you'll only test when a triggering event happens. I had somebody in class 2 say, I said, what could be a triggering event? You know what they said? COVID-19. But they were right, because it's affected a lot of our businesses. Some in a good way, right? If you think about some of the businesses, think about your Amazon, man. Amazon is rolling in it, I bet. And then you think about your delivery companies, such as your UPS and FedEx. When I was traveling from here to Idaho Falls, I'd say it's just a long, straight trip for the most part. And I don't know that I've ever seen 3 trailers. And there's a lot of those. And there was a UPS trailer, man. That last one was just fishtailing like crazy. And of course, then I saw the Wow Factor, and I took a picture. I shouldn't have done it while I was driving. And when I stopped, I stopped. So I got my young son is 17. So I sent the picture to my wife, and they're like, oh, I thought it was cool. And then all of a sudden my son said, Dad, were you really doing 91? I'm like, man, I just got busted. I said, hey, but the speed limit is like 80 for cars here. He's like, really? He said, maybe I should move to Utah. I guess I see where his head is got. But there's some companies that are doing really well, right? There are others that have been severely affected. They've had to either close for a certain part of time, or maybe they can open up with limited people. Maybe they've gone to all, delivery stuff instead of being able to come and sit inside and do things like that. I know we've been restricted from being able to go out to clients and so forth. And so it's just hit a lot. We had one, a not-for-profit that runs a lot of daycare. When daycares were really effective, people got scared. They wouldn't see their kids there when they opened them up. So there's just been a lot that, that when they said COVID-19, at first I thought, that's true. It really is. And so that certainly could be a triggering event. Let's talk about COVID-19 disclosures for a minute. So, when you're doing an audit or a review or a full disclosure compilation, and let's just say you all were doing these, and I'm sure you were just like us doing these in January and February. Well, we weren't putting any subsequent event in there with regard to COVID-19. But once, the World Health Organization said, hey, we got a worldwide pandemic, I don't know about you all, but we kind of put our heads together and had a boilerplate. Subsequent event, we put in every single one of our full disclosure conditions. Just basically, probably just like you all said there. On this day, World Health Organization declared the pandemic. Although we don't know the final outcome, we're evaluating, and that was just boilerplate. What are the notes of the financial statements there for? What are your notes of the financial? What are your clients' notes of the financial statements for that we draft for? All right. What do we have in place for?
Users of the financial statement, people that actually look at it.
Get out of here. People don't read that crap. Well, it does. It gives the user some understanding about how these things are presented, how they're measured, and that type of stuff. It also gives them some insight as to what commitments and contingencies might be out there. When it comes to subsequent events, we've got type 1 and type 2 subsequent events. Those type 1 events might require some amendments to the numbers of the financial statements. A type 2 will be one that just, hey, this happened, we want to draw to your attention to it, that it could impact future periods. So that came out, and we had a boilerplate note. We stuck it in every single one of them. Even though they're our client's financial statement, we went over it. Hey, this is important enough. Important enough. That's good to do it. Important. I have no idea what it means, but it's something like important. I'm trying to speak to that. It is important enough that we feel the need for the user to understand it. We know what's going on. We're evaluating it as it goes. But we just don't know, okay? And it's a bit of an uncertainty still how it's going to fully affect. Well, then the whole PPP loan came out, right? Did y'all get some disclosures around PPP loans? Yeah, we've done the same thing. We talked about how the government has this blah, 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 protection, blah, 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 loan. And if they applied for it and received one, we told what the amount was, we disclosed the fact that said, hey, as of right now, it has the potential of being fully forgiven. If not, whatever's not going to be forgiven is going to roll into a won't should not. And that was basically it. And so that brings me to my next question on interim financial statements in 2020, or even those with fiscal year ends in 2020, for people who have already received those PPP loans. Have y'all issued any yet? Where you've had to, talk to your client about presentation issue? What are you going to do? Well, they're really quiet now. But that's the same answer I've had. Because we don't have final ground yet, do we?
Well, maybe we're going to be shown as a loan currently.
Because that's what it is.
Fiscal year hasn't been forgiven yet.
That's right. Well, what if some people say, hey, you know what, we got expenses out there too, so you show it in income, you see?
Well, you don't show us income until
There's all sorts of guidance out there, but there's no final guidance on how to handle it. Our firm's a member of the CPEA, the Center for Plain English Accounting, and they'll put out some webcasts every once in a while, and they'll say, hey, GAAP doesn't have, they hadn't spoken yet, right? So the FASB hadn't spoken. We don't know how it's going to be handled on a tax standpoint. So, you got different areas you can look at. I've talked to some firms who says, hey, we like what the international standards are, or the ISOs, or the IAS2 or something along in that line. And so we've got a group at our firm that's just kind of monitoring, kind of putting our heads together. And what happens when you have a client who needs their financial statements and there's been no final guidance on it? And that's where we're going to have to make a tough decision. We're going to, they're not our financial statements. And I'm doing a review or an audit that I can't make the decision for them. I think my responsibility is to educate them as to what their options are and allow them to take an educated guess at it. Because I can't make a decision for them. Once I make a management decision, I've impaired my independence, I got a real problem. But boy, I'll tell you, that's here we are November the 5th, right? I say time's flying fast, time's moving the same speed, it's always moves, right? But it seems like there are times when these type things will creep up on you really quickly. That you may have some clients who've got a quick turnaround on these financial statements, that we may have to help them make a decision as to what their options are and how they present this. I don't know when we'll get final guidance on it. You might heard it. I don't know, but I do know I will have some clients with some financial things that will need to be issued. And for us, we will probably take it on a client-by-client basis, tell them what their options are, and as long as I agree, as long as we have an agreement that that's the best way for presentation, we'll go along with it. But then I think, man, if this is an audit, what's sufficient appropriate audit evidence that says this is fairly presented when there's no guidance on what fairly presented is? I don't know, man. To me, it's just a mess. That's just me. But these are some decisions we're going to have to make with our clients going forward too. This second part of this, the first part was goodwill and impairment testing. The second part of this also talks about these separately identifiable intangibles that we can separately identify, that if we can take those, we can subsume those into goodwill and amortize them also. Non-competes, customer goods, those kind of things. Okay? And the lesson is going to apply to all goodwill and all. This just mirrors what the PCC had issued regarding goodwill and intangibles, and it's effective upon issuance. So this one, we don't have to worry about what the effective date is. It's effective upon issuance. Again, simplifying income taxes under top of 740. We're talking about intra-period taxes and how we allocate those when we've got some losses from continuing operations. What our requirement is around the deferred tax liability. Y'all deal with this equity method investment in foreign subs? We may have a couple that we deal with it. So it will eliminate those exceptions. It also eliminates the ability not to recognize deferred tax liability for a foreign sub. If you don't have foreign subs, we don't worry about that. I really wish that the PCC would come up with an election that says, hey, if you're a non-public business entity, you don't really have to worry about deferred income tax. They simplified it before. I say they. Vastly has simplified it on a broad range. When a couple of years ago they said, hey, by the way, instead of showing current and non-current deferred taxes, they're all non-current. And so they're continuing to simplify the approach for accounting for income taxes. Okay? And then again, I'm hopeful that they'll continue to simplify so much that it goes away. This one has a 2021 interim calendar year, okay, for public entities. For non-public, this is a 2022 calendar and 2023 interim, effective date. That takes care of our broad areas. These narrow issues, man, we're gonna blow through these. Because there's just not many, I think, that would, at least based on what Josh told us, there's just not any of these that really affect you. So, callable bond premiums, y'all deal with those issues? Premium amortization on purchase callable debt security, hard pass rate, okay? This one has to do with defined benefit plans and their financial statements, not people who audit, people who have a defined benefit plan. This is defined benefit plans, okay? Hard pass there too. That's exactly what I was told. It just changed some disclosures there. Internal use software, you've got people who develop their own software to use and how they handle that. Am I doing this right, John? Yeah, okay, good, there we go. All right. Perfect. This one, y'all have any people who produce films? Okay. I know, right? Peer-to-peer activity, FASB simplification initiative. Look at this. How will the changes to disclosures in the financial statements of sponsors of employee benefit plans improve information provided to users of the financial statements? Or pass next. So, that's going to take us to the big three, right? RevRec, financial instruments and leases. We will we'll go a little bit into this and then we'll take a break for the day. So when it comes to RevRec, this was our first year, right? 2019 was the first year when we had clients who had gap-based financial statements that really had to implement revenue recognition under Topic 606. So let me ask you this. Prior to 2019, how did your clients find out about revenue under Topic 606? Did they know anything about it? Were they forward-looking enough to say, hey, by the way, I want to come meet with you because I've read this Topic 606, all 700 plus pages of it, and I want to make sure that we're doing this right. Do y'all have clients like that? Yeah, so I was like, could you, can I get the name of it? Because that's not pretty sure. Yeah, we didn't need it. What was y'all's process of educating your clients on Topic 606? What was it before the fact? Was it during our audit this year when we're out there going, oh, by the way, hey, you can't call this that anymore, it's got to be this. And by the way, this process now needs to be a 5-step process. Because with us, we at least had some discussions with them earlier. How long have we been talking about this 5-step process? Anybody remember when Topic 606 was issued whenever this FASB came out? May 28, 2014? I'm sure you all remember that one. It's a great day in life, right? Probably think the last thing on my mind. I had no idea when it came out. I don't really care. We talk about the 5-step process forever, right? It's been pushed out for a year. Actually, if you hadn't issued financial statements yet for 2019, they extended another year. If they weren't issued up until June, I think you could push it out another year, so they would have the option to still have another year. But what we started doing with some of our clients was just having a discussion that says, hey, by the way, you got gap-based financial statements. And I know that you all record things using allowance accounting and all that type of stuff. And we told them, I don't think you really need to change your underlying accounting function. If you have a formalized set of internal controls, especially internal controls around revenue, which you might want to consider, is changing some of your terminology in there to meet what the standard says. And some of them are like, yeah, whatever. We had this thing been updated since 1623, whenever we started this. And we need to update it now. You all, what you think I hired you for in the first place and that type of stuff. And then we think about an audit. One of our first things we do in an audit, right, is gain an understanding of the client, their business, their industry, their internal controls, so that we can assess the risk material in the statement, whether due to fraud or error. Right? That's the underlying core principle of general sector auditing standards. That's what we do. That's what we're required to do. And so then when we're going in and talking about their internal controls over financial reporting and talking about their controls over the 5-step process, did y'all have any of those discussions? I don't know that mine was, hey, let's talk about the 5-step process. I think ours more tended to, the things that you call this right now has new terminology. Has new terminology. When you talk about allowance accounting, my lumber mill client, you'll probably recall I had clients at lumber mill, and they would offer, whenever they would send out, somebody would place an order, right? Then they would send out the invoice, and the invoice was for a certain amount. It said, 210 net, or which means you get a 2% discount paid within 10 days, paid, of course, after whatever, like that. So they had 30 days to pay, but you get a 2% discount paid early. I said, the things you're calling, like discounts right there. That's variable consideration. We're gonna have to kind of document now what you consider to be variable consideration, how you value, all that type of stuff. Y'all are construction contractors, right? Did y'all talk to them about percentage of completion? Or did they have a comment that says, well, all this 666 you're talking to us about, that's payback, that's 666, it says 606, right? Will we still be able to use percentage of completion? And were they still able to use percentage of completion? Yeah, for us, they did. I think the terminology changed slightly, our disclosures changed, and our terminology around it. But what about the numbers? Did the numbers change? Ours really didn't either. For our clients, they just didn't. Now, we walk through the process. We typically get narratives from them about their processes. We have every one of our clients that have GAAP-based financial statements redo their narratives for the revenue processes and how they go through that. And we help them with, I say help them, we educate them on the process of the terms that were typical to topic 606. We didn't tell them they had to do that. We just told them, this is what the standard requires. You have that statements. And so you should probably consider, if you have formal policy, doing this. But in these narratives, you might want to consider some of these terms you're using there and so forth like that. From a disclosure standpoint, it changed. And I don't know how you all did it. What we did is we looked at, we did searches and Dixon Hughes Goodwill, y'all know them? They're a large regional firm. And I know some folks at Dixon Hughes, and they put out about 21-page PDF of common disclosures on the topic 606. And I thought it was really good, and a lot of our folks in the office thought it was really good. So we took that kind of on board. And so we went through that with how our disclosures are. Because that's where it really changed for us. And, your audit programs, do you know those things changed? For testing revenue under topic 606, and it has specific testing for performance obligation, variable consideration, all those types of things. It had that language within your testing. And it was similar to a lot of the testing we've done, which is terminology change. But for us, I hope I haven't totally missed the boat, and our peer reviewer comes in and says, ooh, man, I don't think you did this quite right. We'll find out. In fact, a couple of our partners, QC partners called me last night because for years, we've had our own peer review done with the National Peer Review Committee, which that's typically done for folks who do like public company or who were registered with the PCAOB. Our first been registered with the PCAOB for a number of years, but we hadn't done that type of work in a while. And so my partners who were getting scheduled called me last night and says, do we really need an NPR peer review? So we pay our fees to the PCAOB, we pay our PCAOB fees. I'm like, for what? Well, I'm not really sure about that. I said, we don't have any engagements that are due to be expected by them. But no, we don't. We just always pay them. And I said, well, here's the deal, I'll pay them. What benefit to getting out of it, except you got NPR, National Peer Review done. Those typically take long and all this other type of stuff. So we're not going to do that anymore and be subject to it. But I hope our peer reviewer finds that we at least we're pretty consistent in how we do it, and we hope we have good documentation in the file with what our required disclosures are. Your file and how you all handle it. But our system quality control says for every full disclosure engagement that we do, we're required to fill out a disclosure checklist. How many of you all like filling out a disclosure checklist? Partners don't even be laughing because y'all don't do it. We don't do it. We got to review them. And that's a bit of a barrier. They're tough. A lot to them. But how are you going to know what disclosures you're getting if you don't do those type things? Because we actually ran into a couple of ours where, it's going through we call all our partners members, it's either go through member review or through QC, and we've just rolled some of those engagements from the past, and we had updated our disclosures for topic 606, we had to send back and hey, by the way, you missed the boat. We would look back, and they kind of put maybe NA on that on the disclosure checklist, when it shouldn't be NA. So we've talked about revenue in topic 606 for a lot of years, and this was our first year to implement. It took us more time because we had additional steps, or new steps to the procedures that we performed. We had additional disclosures that we had to go through. And so for us, we think we did it right. We hope we did it right. Yes, sir.
Do you have examples where they had to recognize because all the obligations were historically?
We did not run into any of those. The question was, did we have any clients who we had to recognize revenue because they typically had to recognize revenue because they didn't have what they would determine to be a performance obligation at that point in time. Okay? Now maybe it's one of those that we allocate revenue a little differently when they had sales of a product and a service that goes with it. Well, we always count those as one of the major services went on a little bit longer, where maybe there's a little bit of a reallocation or an allocation of a discount and so forth. But we didn't have anybody recognize more revenue because of performance obligation. Have you all?
We have one.
Okay.
That kind of was,
What type of industry, if you don't mind me asking?
it was the publishing industry.
Publishing, okay.
They did some custom work for a bigger customer where they had like a quarterly agreement on what they were going to supply. They built it ahead.
Okay.
And it was all finished inventory, and under the terms of the contract, they could just, right? It was just, they were just holding it more on the need for the client. And historically, they would just, they would pick up the revenue as they ship.
Yeah.
Technically, they should have been that they were just holding.
Okay.
So in that case, you recognize.
Because they can control and pass it or something like that. Yeah.
Warehouse, and they would ship it any time the customer wanted. They could technically bill for it. The customer said, we're going to enter a contract. At that time, they bill for all of it. If they can do it, it wasn't.
Yeah. See, that's for us. It was determining how that contract was written, basically. If it was a written, or whatever that agreement was, it doesn't have to. Whatever that agreement was, based on the terms of the contract. And you typically think about, before like free on board shipping point or whatever like that, where maybe some of those terms might have changed. That could be a little bit. One of the things that we had to consider this year for our construction contractors were some of these costs of the contract that talks about maybe you capitalize. Well, what if that carries over to the next period? And we didn't have any of that or material that we had to capitalize. Those things that are typically we put in the WIP work process, that we might have to separately capitalize some of those costs and stuff. So that was some of the evaluation of some of our construction contracts, because that would have been a little bit different than how they had to do it in the past. When they hadn't recognized it, when you still had the asset that you hadn't recognized it here, we typically would. And so all of those were really kind of immaterial anyway. But we had to go through this whole new thought process with our clients. And it took a little while. And, looking at them while we're talking to them was probably kind of how y'all feel in this class right now. It's just, y'all are doing that because y'all are very engaged. And under your mask, I have no idea what's going on. That's the thing about masks, isn't it? You walk by people now, you're in the store, you're out somewhere, you're like, hey, how you doing? You may be, hey, you're like, kiss off. That's the funny thing about masks, right? When you see eyes kind of slant, you think, oh, they're smiling. They're not. That's the great thing about masks, right? You think, yeah, you just if you're doing it. But we've been having all these discussions with our clients. And it has taken time. And Most of them have a grasp on it. I was a little leery going into it because I had talked to some people who had worked for public companies in the accounting function in some public companies. And they said, listen, we have hired consultants that have come in. We've spent hundreds of thousands of dollars getting things in place to implement this and so forth like that. And I'm thinking, man, our clients didn't go through all that type of stuff. I don't know if yours did or not. And then we went through it, and we think we documented everything the way it should be, of course, with the standards. But I guess we'll see soon. Have y'all read anything that's just really giving you heartburn with topic 606? See, I'm perfect too. Okay, well, let's start talking a little bit about revenue under topic 606. Because again, we've been talking about the 5-step process forever. Seems like, to me, forever. We've been hearing about it for forever. So there it is, May 28, 2014. Topic 606 was issued. Again, a little backstory about why this is what it is. This was a convergence project with the international standard setters that took 10 plus years. That FASB and the International Accounting, the IASB, got together and said, hey, by the way, we know it's going to be a global economy sooner than later. We would like to have some type of standards around, revenue that gives us some consistency on whenever you look at financial statements prepared under U.S. GAAP and maybe our international standards. That, you're looking maybe at apples to apples instead of apples to oranges. And so they went through that whole process. Again, it took them 10 plus years to do. They issued a standard that was 700 plus pages long. I didn't ask y'all the question earlier. I usually like to ask, who in here reads professional standards? Anyone?
All of them? The entire?
No. Just read those other kinds of applicable to your practice. Yeah. And people are not proud of raising their hand. I mean, it's like a shameful thing. How else are you going to get the stuff, right? You're going to rely on people like me to tell you, hey, this is exactly what it said. I could be blowing smoke. I might be blowing. How many I forget things? Remember earlier? I forget things. There's some you need to get in and read. Now, this one's long and thick and has a lot of stuff in it. I can't say that well, I read most of it, cover to cover. But there's a lot of stuff in there you just kind of skim through. It's got things drawn through and stuff like that. There's some things that you really need to get in and read. Because if we're going to perform a service for our clients, revenue for your client. When this first came out, okay, I thought, well, first of all, my clients they don't like contracts. And then I read in there what they determined to be a contract. I'm like, oh yeah, they do. So I always thought the written contract, right? That was my initial take. Well, they don't have a written contract. And so I'm not worried about that. And I'm like, it doesn't have to be a written contract. And they're like, okay, everybody. And then I start, as further guidance goes along, I thought, well, we do a lot of not-for-profit, we don't have to worry about it for them. Well, you might have to for not-for-profits, right? In fact, guidance was put out just a couple of years ago, probably 2018 issue, that came out and said, hey, by the way, that they may get these grants. And what happens with these grants? Should these grants be contribution or should it be an exchange transaction? Let's just say it's got a matching part of it, right? And then we start thinking of other things like some of these not-for-profits have membership fees and dues. When you pay a membership, let's just say you pay a $250 membership, well, what does that get you? Well, I can get into any one of the galleries at any point in time of year without paying for it. I get X number of visits to the museum, so I'm getting commission value topic 606. So it may even apply there, right? They do fundraising and you pay $200 to go to an event, and $50 goes to the meal. Okay, that makes sense. What do you get for that? Well, maybe the other is a contribution. Well, maybe the other is part revenue. You have a silent auction. Okay, there's just a lot. Man, it just goes in depth. And you think about this. There's not going to be really any of your clients who have gap-based financial things that this may not apply to. And so, the deeper you get into it, the more you see, hey, yes, that it does apply to everybody, really. So again, their objectives, this is what they hope to get out of it, was to remove inconsistencies and weaknesses. Well, maybe that'll happen, because if they want to remove inconsistencies, well, when you can take guidance from here, 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 and here, based on what industry you are in, okay, I'm kind of buying what you're showing, because now for consistency's sake, everything's from topic 606, but here's the deal, it's a principles-based standard. You understand the concept of a principles-based standard versus a rules-based standard? If this were rules-based, it would say every time you will always do this, always do this, always do this. This is the way you record it each and every time. You'll always consider this to be a performance obligation. That's not the way this one's written. This says you should, you might, you may. So it's principles-based. It allows us to use professional judgment on how these things will be put into place. So, okay, maybe provide a more robust framework. I don't know what it is about the term robust, but the standard setters love to use the term robust. Have you noticed that? You have a more robust disclosure framework. You're going to have more. When I was on the ARS, the Accounting and Review Services Committee, I guess I could say we had robust discussions, which means we were probably raising our voices, fussing and fighting. Well, now you're going to have a more robust framework. Okay, I'm probably about 1% on there, because how many of your clients had a formalized 5-step process to recognize revenue? Mine did. Mine said, hey, when I asked about the revenue process, we bill, we get paid, take it back. So I do 3 steps. Okay. And so they didn't have a formal 5-step process. So yeah, okay. In theory now they got to have a more robust framework. Improves comparability of revenue recognition practices. Yeah, everybody's running in the same pool now. Everybody's in topic 606. Although you have all these transition resource groups that are industry specific groups that says, hey, typically this is how we think we're going to see it in this business or industry or whatever like that, and you go forward. Provide more useful information to users of the financial statements and disclosures. Again, I'll say this, I've said this every time I presented this, if you were to take out the term useful, I think that is a true sentence. Take out the term useful, provide more information to the users of financial statements and disclosures. They knock it out of the park. Now, how many of your clients, when you hand them their financial statement, says, I need you to approve these so that we can get issued? Because they're your financial statements. And your responsibility for preparation and fair presentation of it. You agree to let us help you with that? We think this is it, but these are your financial statements. Now, how many of them fully read all those note disclosures and everything like that too? Say, no, I'm in total agreement with that. That's exactly how we do it. I don't know that we have a lot to do. Do y'all do any government work? Government work? Government work? One? Yeah. If you deal with OPEBs and pensions and so forth like that, under GAD 75 and 68, they have like notes for days. I'm talking probably 6 pages of notes for each one of those issues. And they talk about actuarial, blah, 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 all this other type of stuff, and actuarial analysis and tables and everything like that. I remember sticking that in front of my client for the first time. So you need to read all this and make sure that you're in agreement and that you approve these financial statements. And this was our school board, so I gave to the chief financial officer. He was a former football coach who kind of got grandfathered into the position. Yeah, you see my goals, right? So he read through those 38 pages of notes, and he says, Mike, I see it uses the word sex in there. That's just funny. Because he said that was part of the mortality rate tables that they use in the actuarial analysis, and that's what he got out of it. I hope. I'm serious. I can't make this stuff up. Dude was about to sound short of a pig. Bless his heart. He was a nice dude, but he really got grandfathered in the position. He's no longer there in that position and so forth, and it's so much better run than that. But understand this, these are their financial statements. And the whole adding no disclosures to this should give more useful information to the reader, to the user. And part of the things I'm fearful of is this gives our clients a set of financials that they don't fully understand when it comes to the notes and everything. And one that's not as useful to them, possibly, as what it was in the prior standards. And I don't want it to get to that, where it has, I'm afraid Lisa County's gonna get there. You know, but we'll talk about that later. So it does provide more useful information in the notice of disclosure. So they knocked that one out of the park, right? And it simplifies financial statement presentation. I believe that to be a true statement. Because now on the face of our financial statements, when it comes to the income statement, or statement of comprehensive income, whatever we call it, revenue from contracts with customers. And that's a single line item. And then we took that cost under that, other revenues, expenses, and that's it. So for our income statement presentation, it simplified that disclosure. I say that disclosure, it simplified that presentation. Okay? I'll tell you what let's do. Well, we'll cover this and then we'll take our morning break. How about that? So this was one of the first ASUs that was issued. Well, no, this is just the continuation of it. So this one says, hey, it's going to apply to anybody who enters into contracts with customers, transfer goods or services, or non-financial assets to members of non-customers, unless those contracts are within the scope of these other standards. So these are the ones that are scoped out. Everybody else that applies. And so for all of our clients, we didn't have anybody who was scoped out, whether they were a government contractor, or whether they're a construction contractor, an ambulance service provider, a not-for-profit entity, a manufacturer, service organization, they all fell under the topic of 606. Did y'all have anybody who didn't? Unless they were like tax basis, if you did any tax basis financial statements, any other comprehensive basis of accounting, any of your special purpose frameworks, they don't have to. There's your core principle. You recognize revenue, pick the transfer of goods or services to customers in the amount that they expect to be entitled to in exchange for those goods or services.